Hi guys, welcome back to Tax Q&A. In today's video, I'll be answering all about capital gains from stock market. So let's get started. See, whenever you purchase any asset like a house, land, gold or even stocks, its value is likely to go up with time. And when you sell such assets, the difference between your buy price and sell price would be your capital gain or capital loss if you're not in any luck. Because we are talking specifically about stocks, if you buy a share for say 100 rupees and sell it for 140, your profit is 40 rupees, which is your capital gain. If you buy another share for 100 and sell it for 90, you have a capital loss of 10 rupees. So a net gain of 30 rupees and this amount would be taxable, just like any other penny you earn. Okay, the tax rate on capital gains depends on two things. One, your holding period, and second, the type of asset. Holding period is nothing but the time for which you are keeping an asset before selling it. When we talk about listed equity shares, if your holding period is less than 12 months, your gains will be short term. If your holding period is more than 12 months, your gains will be long term. Now, your short term gains will be taxed at the rate of 15%, whereas for long term gains, 10% tax is applicable. For other asset classes, the tax rates will vary based on the holding period. Here's a table that you can refer to. Yes, if you're investing in mutual funds via anything, either SIP or lump sum, and sell those units, the profits that you make are taxable. For equity mutual funds, the taxation remains same as in case of listed equity stocks, 10% for long-term gains and 15% for short-term. However, because various mutual funds invest in a mix of assets, the tax rates would change if your mutual fund is non-equity oriented and invests in debt instruments. In that case, the gains are taxed as per your slab rate, irrespective of the holding period. Further details are covered in our tax Q&A thread. We'll add the link in the description for you. See, there are mainly two ways to invest in foreign listed stocks. First, if you're directly buying foreign stocks. In this case, your short-term gains will be taxable at slab rate and long-term gains at 20% with indexation. The holding period here would be 2 years. And second is through mutual funds or ETFs that invest in foreign markets. Profits from these are taxed at slab rate regardless of the holding period. Well, you can claim the expenses which are wholly and exclusively incurred on the transfer of shares like brokerage, stamp duty charges, etc. and calculate the net profits. Moreover, for listed shares and equity mutual funds, you do get an exemption of Rs 1 lakh on long-term gains, and if you reinvest your gains into a house property, you can claim an exemption under Section 54F. But unlike other incomes, any Chapter 6A deductions like ADC, ADD, etc. are not allowed on capital gains. So, up until 2020, dividends were in fact exempted from taxes in the hands of investors. But after that, they were made taxable. A 10% TDS is applicable on dividends over Rs 5,000 and the company paying this dividend is liable to deduct it. Hence, if you were to receive a dividend of say Rs 8,000, you would get 7,200 in your pocket after taxes. And this is not it. Dividend income is taxable at slab rates. Hence, if your total income falls in a higher tax bracket of say 30%, you would have to shell out more taxes on your dividends. No, you don't have to pay taxes if you have made losses. You have suffered enough. But one thing you should not forget to do is to file your ITR. This way, you will be able to offset your losses against other gains. Even if you don't have enough gains in the current year to set off all the losses, you can carry forward your capital losses for 8 years and use them to offset your gains in the subsequent years. Just remember, while you can set off your short-term losses against both long-term and short-term gains, your long-term losses can only be set off against long-term gains. ITR 2. This form would be applicable when you have any kind of capital gains. Along with this, if you have any salary, rental income, interest or dividend income, ITR 2 form has the schedules for all of these. Only if you have any business or professional income, you'll have to go for ITR 3. And it's a wrap. If Google search is too much work for you, Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one. This is another level of intellect. Another level of intellect. तुम लोग उस level पे पहुंचे नहीं. Oh my god! I thought.
किसने लगाया ये?
I need a vanity van and all.
Oh my
like all of
God.
this.